Hi, everyone, and thank you for joining us today. Um, so welcome to today's technical assistance webinar. This webinar is presented by Amity Foundation, acting as the third-party administrator for LA County's Justice, Care, and Opportunities Department and the CFCI Care Grants. The CFCI, or Care First Community Investment Grants, are the result of ballot measure J, voted in by LA County residents in 2020. Care First Community Investment Funds are intended to be invested caused by racially driven criminal legal system inequalities and long-term economic disinvestment. Today's webinar is being recorded. You do not have to be on camera. Understand, however, that if you are on camera, your image may be captured in the recording. Staying on the webinar represents your consent to being recorded. So know that because we are recording this, it will be sent out to every single grantee and along with today's presentation. So today we are in part 2 of our presentation conducted by our finance team. If you guys want to go ahead and introduce yourself, the webinar is all yours now.
Sure. Thank you, Mina. And hi, everyone. Welcome back. For those of you who joined the Series 1, if you did not join that, this will still be useful time for you, but please do look at the Series 1 webinar. My name is David Crawford. I'm the Chief Financial Officer of Amity Foundation. I've worked with Amity for 7 years. Before that, I was CFO of HealthRate, Chief Financial Officer of HealthRite 360. Some of you may have heard of that organization, based in San Francisco, but has a number of programs in Los Angeles County. And I am going to look to my team here to introduce themselves. We all collaborated to put these materials together for you, so they are just as much to be credited and also maybe blamed for what I'm about to present. So Lorenzo, why don't you start?
Yes, sir. Thank you. Hello, everyone. I'm Lorenzo Gonzalez, an accountant here for TPA Finance. I've been here since March of this year. I'm very happy to see so many attendees, and I think you're going to get a lot out of this. So thank you very much. And I'll pass it on to Sandy.
Hi, everyone. I'm Sandy Kleinschmidt. I'm the Senior Vice President of Amity Foundation of the Finance Department. I've been with Amity for almost 8 years now, and welcome. I'm glad everybody has joined. Let's see, Samuel.
Hi guys, my name is Samuel. I'm also with TPA Finance. I have been with Amity for a whopping 3 months, working in cohort 3. So it's been a great 3 months here, and I'll pass it over to Dondell.
Hey, everybody hear me?
We can
Yes.
hear you.
Hi, everybody. Sorry, a little password trouble. Got it fixed right in time. Don Dell, been with TPA Finance a glorious 4 months. Spent a lot of time though in the financial tech background, working for Intuit, and really excited about this second installment. Really appreciate the engagement the last time. I look forward to helping ensure you get the most out of this time investment.
Thank you, Don and team. So I'm going to do the presenting. The team will hop in when I get stuck, or they have valuable insight to contribute. So let's get going. If you're a coffee drinker, hopefully you've had a little bit. If not, now would be a good time. We're going to look at a bunch of numbers and talk accounting. So let's get going. So the first thing our lawyers make us do is put in this disclaimer. What I'm presenting in all 3 series is not legal advice. It's to provide information. You should independently verify any of the information that I'm presenting to make sure it's applicable to your organization and your situation before acting on this information. So let's get going. So we're in this is series 2, as we've mentioned. I'm going to stop at 1.5 hours. We have 2 scheduled. I just think that's too much. If I don't get through everything, we'll just pick it up in series 3, which is next week on Wednesday. So today, what we're going to do is I'm going to go through some PowerPoint slides here as quickly as possible to then go into an Excel model that I've discussed and presented snapshots of in a PowerPoint last week. We're going to go into it. We're going to share it with you, and we're also going to share this presentation with you. So don't worry about taking screenshots and writing notes. We'll send this out to you along with the Excel spreadsheet that I'll be sharing. And we are then going to send you the same Excel spreadsheet in the Series 3 training, but empty, so that you can use it if you think it makes sense to use it for your organization. So, and we'll work through it and build it together in the Series 3 training. But Series 2 right now is looking at the Excel model predominantly, getting you comfortable with it, understanding it, and fielding any questions. And then we'll dive in and build one next week. So today I want to do a quick review of last week, just to make sure we're all starting at the same place. We're going to go into the Excel model. I'm going to review each tab that's in it, explain to you, what it is and why it's in the model, why it exists, and then I'm going to start diving into the cash flow. This is the title of this training is cash forecasting, and so we're going to dive right in, and I'm going to talk about how we go about forecasting cash flow, and then get into the daily cash flow, which is exactly what it sounds like. What's my cash today, and what do I expect it to be tomorrow and the next day, and so on and so forth. And I'll hopefully do a quick recap, and then answer any questions that you might have. First of all, I wanted to follow up on some questions from last week. Some of this is going to be repetitive, but I think it's important to reiterate. So there were a number of questions around surpluses and reserves. To be clear, surplus exists when your actual cost, your actual spend, is less than the grant funds that are awarded. And think of it in quarterly installments, because we pay you in quarterly installments. And so did I spend less? The answer to almost all organizations, in fact, it may be all organizations, is at least initially, yes. It took us a while to hire some individuals, and the way you were paid was assuming that you had those employees, exactly on board day one, which is rarely the case. So that's what surpluses are. They can be redeployed to a future period. So you can spend a little bit more in a future quarter if you've got surpluses or reserves from a prior quarter. And you do this through a budget transfer request. And the team here, Dawn, Sam, and Lorenzo, are the folks to help you through that. You can include unbudgeted costs in your quarterly spend. So if there is something you didn't anticipate, and from this training, I think some of you are going to realize that maybe you need to hire an accountant, or you need to get some payroll or human resources consulting advice or resources, that sort of thing. Those can be added in a line in your budget, your quarterly budget templates. You cannot spend more than your grant amount, though. So there needs to be savings found somewhere else in your cost, but know that you can add new costs as you identify the need for resources, and in particular from this training. At the end of the contract, you should assume we're going to ask you to reconcile to your actual costs. And so if your contract was $100 and you spent $95, you should expect us to ask you for those $5 back at the end of the contract. And there was a question around, can you budget a reserve as a line item or a surplus or a profit? And you cannot. That's not an allowable cost to include in your budget to actual. There's questions around federal and state annual tax returns. We realize there needs to be training on this, and so I'm going to be working with Mina. We don't have enough time in this series to go over the tax filing requirements. There's a federal form called a 990, a California form number 199, and so those need to be completed. And so we'll provide future training and walk that through, with everyone. And another question that came up was around labor laws. Mina had sent out a link from the state website, and so it clearly, gives detail on, confirming what I asserted last week, which is every company or legal entity in California is required to have minimum of two pay periods per month. And what's most typical is a pay period on the 15th and of the middle of the month on the 15th, and the last day of the month is one way in which companies do it. Another way is two different dates within a month. So Amity has a pay date on the 7th and the 22nd. And then a third way is every 2 weeks. And so on the every 2 week schedule, some companies actually have three in certain months, since they're just a little bit more than four weeks, in a month. So we are also going to provide future training around this idea of labor laws. So I've emphasized payroll, but there's other things. The requirement to pay staff, hourly staff, every minute that they work, that they have meal breaks, that they have work breaks. And again, there's much to talk about here. We don't have enough time to include it in this training, but we've realized from the questions that we should provide this training. So this is the recap from last week. Defining cash flow is your change in cash over a period of time. And think about your bank balance, beginning of today and then the end of the day, or it could be over a week period or a month period or a year, but that's what we mean by cash flow, the change in your bank balance over a period of time. We talked about setting up your accounting system and this idea of a chart of accounts and having it map your reporting requirements, your external reporting requirements, so your JCOD and your 990. And I mentioned QuickBooks is the most common software system for smaller businesses, which typically applies to the TPA awardees. And so if you're looking for one, highly recommend. And a simple Google search will pull up QuickBooks, which is a product of Intuit, which Don Dale is a company that Don Dale worked for, as he mentioned. And so, and also the link to the Intuit's QuickBooks is on the Series 1 materials and in that video if you're unable to find it on a search. So then we talked about, okay, set up the structure of your accounting system correctly. That's the chart of accounts. And then how do you input your data and your cost? And that's through this idea of a bank reconciliation. Important that all get into the system, and then you have confidence that your financial information, your costs, and your spend is accurate. And so super important that bank reconciliations are done every month as quickly as you can get them done once you receive your bank statement. They're typically available every day, so you should be able to get it the day after the end of a month. And then you can use that actual information, your actual spend, to help you forecast. So you look at your utility bill and it was $100 and it's been about $100 the last 6 months. And so it's realistic to assume it's going to be $100 per month going forward. And so you can do that through all of your different kind of spend categories. Look at your historical experience, and it's a great way to predict and forecast what your future spend will be. And then we emphasize, as it relates to cash flow, the importance of getting your quarterly information into us and have it be accurate so that we can turn around and invoice JCOD, which is essentially LA County, get paid more quickly so that we can turn around and pay you all. And wanted to go through this important calendar again, excuse me. So for cohorts 1 and 2, this applies. So quarterly reporting was due on December 5th. And if you got it in and we reviewed it and approved it by December 13th, which is Friday, we'll include it in an invoice to JCOD on the 18th. Excuse me. I might have to go get some water. I feel this one coming on. Excuse me one more time. And so if you miss the 13th, then your next opportunity to finalize your quarterly information is the 20th, the next Friday. And we will include it on an invoice to go out on the 25th. I'm going to stop for 1 minute and get some water. Excuse me.
And while David is going to get water, maybe someone else can answer this question. If we hire an accountant and add it as a line on our budget, does that count as a direct cost or is that an indirect cost? Does it come out of the maximum 15% for management or the direct cost portion of the budget?
I'll take that. Okay, if the accountant you hire is only going to work on this grant, then that is a direct cost. If the accountant is going to be working on other grants that you have, then it would fall into the management costs.
Thank you, Sandy. I am back with my water. That is a correct answer.
And
So
can I add one thing, David and
Sure.
Sam? And in the instance where you don't have any other grants, but this person is contracted out, is there, treat that's an indirect, correct?
No, it's still direct.
Okay.
So whether it's a contract or an employee, if it's only for JCOD, like that's the only
That's the,
contract you have, that is, everything's direct
Okay.
in that scenario. Nothing's shared, right? As we talked about, it's when there's a shared cost, typically, accountants, HR, human resources, or information technology are shared, and so they need to be allocated to multiple contracts, more than one, and you do that through the indirect line.
Thank you.
And we also call it, remind me, Don, what we call the indirect line.
Project management.
Project management. Thank you. Okay, so let me continue. Sorry about that. I'm doing much better. And so what I've done is I've gone through for cohorts 1 and 2, the time frame for when we can submit your request for reimbursement to JCOD, which then goes to LA County to get approval. So the idea here is you request to be paid by submitting your quarterly information. We then give it to JCOD and LA County for them to approve after we've approved it. And they go through a process of approving it themselves, potentially kicking it back to us. What I've learned is that almost never happens. That once we submit the information, it's accurate. So the idea here is that if you miss the 13th, your next opportunity to get for us to get your invoice in is the 25th. And if you miss the 20th, the next opportunity for us to get an invoice in is on January 1st. So we finalize awardee submissions on the Friday schedule here. JCOT only wants 4 invoices, so there are 4 opportunities here, and this is what they look like for cohorts 1 and 2 for this upcoming quarter. And then what happens is, when do we get paid and when do we turn around and pay you? It's almost always next day, no more than 2 days after we receive payment from JCOD, we turn around and pay you, so we don't hold on to it. We can't predict exactly when we get paid, but based on experience, this is when we expect to get paid from JCOD for the first invoice. So we can then turn around and pay you, and you get the idea. If it takes you longer to get the information in, it takes us longer to pay you. So this is the second invoice in blue, third invoice here, and I'm going to call this purple, and I'm just going to call this orange for the 4th invoice. And so super critical for me to highlight the yellow here down below. If you miss the 4th opportunity, you get kicked to the next quarter. Again, JCOD only wants 4 invoices, and so that's really a disaster. We just absolutely need to make sure that doesn't happen at a minimum. And part of what I'm going to emphasize today, and I emphasized last week, is that please get the information in so that we can turn around and get you your funds sooner. And there's just not anxiety around paying your employees. And so we're going to get into that quite significantly here. So Mina, maybe if there are any questions, I'll take some now before I move on to Excel.
Of course. So we do have a question. Our organization operates under a physical sponsor. So our indirect line in the budget accounts for the physical sponsor's fee. Should we then include in the budget a percentage of staff salaries from general roles, i.e. programs and grants teams allocated to this program?
So I want to make sure I understand the question. So these are for the fiscal sponsor costs that they're incurring on your behalf. Do you include that in the program management line? Did I understand that correctly, the question?
I believe so.
Team, Sandy, does anybody or anybody want to tackle this question?
I can. Basically, because a fiscal sponsor is working directly for you and they should be charging you a fee, that would be a direct cost that could be included on your line item budget. It is acceptable as well, though, to put it in the management costs, but be it as it is, only on your grant, it can be a direct cost.
That's right. That sounds right to me. Thanks, Sandy. Good, really good question. I hadn't thought of that use case. Mina, any others?
Of course. Oh no, sorry. I can answer
Okay.
these.
Okay, great. Thank you. Yeah, I'm eager for every minute, so I appreciate you knocking off any questions you can yourself, Mina. So, Mina, can you confirm you're seeing an Excel spreadsheet?
Yeah, we can definitely see.
Excellent. So this is it. This is where we're going to spend the rest of today and next week is in this template. And what I wanted to do first was just describe to you the different tabs here. And so working from left to right, this is the user guide, kind of the operating instructions, if you will, of the model. I emphasize this color coding, which I'm going to talk through in a minute here. The green color tabs, and then there's yellow and purple. And then I describe, below, as you can see, what's going on in the green tabs, how to build the model, et cetera, et cetera. I'm not going to walk through this. We'll do it next week. What I want to do is just move to the tabs. So we'll cover this. Feel free to look at it. Mina, again, we'll send this this out to you sometime, by the end of this week, along with the PowerPoint presentation I just went through. So the green tabs here are the most important outputs of this is what the information that we want to be able to understand is our cash flow in a good place or in a bad place. And so these are going to be the most important tabs for us as we're thinking about the usefulness of this tool. But we need information that is in other tabs that goes into the green tabs. And so it's super important that that information be entered, and I'll talk about that in a minute, because the green tabs are just the math, if you will, essentially behind the other tabs, and I'll get into that in a moment here. The purple colored tabs here are the 3 standard financial statements that public companies issue, that non-for-profits issue. If you've heard about, people talk about financial information, they talk about the 3 statements, and the 3 statements are the cash flow and the balance sheet and the income statement. These are not going to be super important for us other than the income statement. So the balance sheet and this cash flow here is not going to be super useful for us as we think about this tool. It is useful to see it, and to the extent you hire somebody of an accountant or bookkeeper, they'll be very interested in seeing the purple tabs here, and I would get into it more if I thought it were useful and we had the time. But for now, I'm not going to in the 3 series training. The yellow sections here are where and this is how, when I build models, this is how I build my models. Yellow is an assumption or an input. So you're going to pay somebody a certain dollar amount. You put the salary into the yellow section, and we're going to do that. We're going to look at that in a minute here. This is where we put all of our cost information, also our revenue information, and you'll see that in a moment. And it then populates the income statement, and it populates other things here. So super important that we get the information in correctly, and I'm going to start looking at it. Just one moment. There's 2 other tabs here that I thought would just be useful information. For those of you who were in the training last week, I showed this as the bank reconciliation. So this is the important process you go through every month, as I've said a number of times, and so I just wanted you to see it to remind you. So it's not part of the model. It's not doing anything. In fact, when we give you the blank template, I'll delete these so they're not confusing. And then I just wanted to show the budget, the JCOD budget to actual template that we ask you to submit. So it's just there for you. I will delete these when we give you the tool that you can use. So let's start looking at the yellow tabs here and what is going on here. And so what I've done here is I've created a fictitious use case, and this is a grantee or an awardee that received money from JCOD, and then also has another program. What the income statement does here is it adds up the 2 programs. If you're looking at my formula up here, it's just adding program 1 and program 2. Now, for this purposes, I've zeroed out program 2 because we're gonna build this next week, and it allows us to put 2 different programs into the model. Now, if you have 3 programs, you'll need to add the program here, and we'll do this, next week. I won't do that now, but I'll talk that through with you. And so you add all of the programs you have, whether it's just JCOD or whether it's 10 or more. You add a tab for each. Okay, and they all sum up here into the income statement. So in my example, it's just these 2 programs again. So what we're doing here in our JCOD income statement is we are, and remember, yellow is an assumption. And so what I have, let me make this a little bit bigger. What I have in my chart of accounts, right? This is essentially my chart of accounts, is I have the revenue up here, and I have a section for the program revenue. So this would be the JCOD amount. And in my example, it's a 3-year award. I don't know how I came up with these numbers, so they just, again, fictitious, but a $428,000 annual award for 3 years. And so you input that here, and it will then calculate how much you earn every month. And what I have here is 12 months. So we're just looking out 12 months. That's sort of best practices around, you put together a 12-month budget, you manage to that budget, and then you put a new 12-month budget in place for the following year. So we don't go out 3 years, we just look at 1 year, but you put in the full contract amount here, and that's your revenue. That's what you will earn over the grant period. And then we have our expenses or our costs. Same thing, expenses and costs. We have a salary line, and it's coming from the payroll tab here. We're going to go look at that after I walk you through the format here. There's no yellow here, right? So this is not where I have my assumption on what my payroll costs are. It's coming from somewhere else. So know that about the way the model is structured. And then your benefits, right? This is their base compensation, and then we offer benefits. We offer health benefits. Workers' compensation is one of the more expensive insurances and benefits that we offer. We're responsible, companies are responsible for paying taxes on behalf of the employees. So this is the employer share of taxes paid. Think about Social Security as an example. There's others, and so that's what this represents. And then if you have other benefits, you can put them in here, to make it relevant to to your organization. And the way the math works here, and this is best practice. I shared last week, I've been doing this a very long time. I've been CFO of an organization for 24 years. So I'm seasoned. And this is, what I view as best practices is you use a percentage of your salary here. And we'll look at the salaries here. So 20% of this salary is my health benefit costs, and you'll determine what this is on your own. You're going to look at your actual data, from your bank statement. What am I paying Kaiser, whoever your health insurance provider is, and you can calculate what this is. This tends to be about sort of the industry amount. It can vary. It can be 15%. It can be more, that sort of thing. And so on and so forth. So workers' comp is a percentage of the salary. Employer taxes is a percentage of the salaries you see here. And so that is the way you determine the benefit costs, is based on these percentages. And you want to look at your actual spend, calculate the ratio of my health benefits to my salaries to come up with what percentages is meaningful for you. These should be directionally correct, right? They should be close, but you need to come up with your own to be more precise. And so these are what we we essentially call headcount costs, salaries and benefits. We have other costs that are non-headcount costs, and the typical ones here are rent and utilities and communications, and these are largely standard. You know, you'll have your own, you know, based on the work that you do and the vendors, you know, that you need to do your work. So these will vary, but this is where you want to put in an assumption on a monthly amount of spend. And so we rent, you typically know you've got some. I'm gonna do some formatting here. I should have done before. So rent, we you know we typically know we have a lease in place, and so we know what that spend is. Utilities can vary, right, month to month, that sort of thing. But again, we look at our historical data to inform us as we're forecasting. And so the idea for everybody in this webinar is this is where we put in our assumptions on all of our spend that is non-headcount related, that is also not indirect and program management. Hopefully I use the words correctly. This is again accounting, HR, information technology, et cetera. Those costs that are shared can be entered here. And the way I've done it is I've just done it in total. You can do this in a more detailed level. You can say, well, $300 is my accounting, $200 is my human resources consultant. You can, you know, certainly build out the detail. But this is where you input your assumptions on what that spend will be. And what I'll do now is I've gone through everything but the salaries. So I've talked through the benefit costs, I've talked through the non-headcount costs. How do we come up with the salaries? Well, that's what this payroll tab is. And the way the payroll tab, remember we got yellow all over the place. So this is where it's important that we put in, you know, accurate information. And what I have here are compensation amounts. So you include all of your positions here, and you include what their offer letter says and what they're paid. And you then put in what your assumption is on their start date. And so you see here that I have 3 positions that don't start immediately. I have them starting on August 1. And this this example here would sort of most apply to cohort 3. Those contracts started essentially July 1. I don't know if it was exactly July 1, but for cohorts 1 and 2 and PA8, you started, you know, years ago, and so you won't see, you know, this sort of a ramp up. But as you start a new program, and so in a future in your, you know, forecasting, if you have a new contract, you know, say program 2, you can put in like what the hiring will look like, and what 1 represents is 1 person. And so you can have partial, people aren't partial, but you know, partial time that people are allocated or used for a program. So I could make this, you know, half of a person, for example, and we'll do this more next week. As I've said, I don't want to get into building this, but in this example, these assumptions on when people are hired and when they're employed calculate what the salaries are. And so if you recall, what we looked at was the 10,000 right here. And we then are fully hired by August 1st. And so my salary becomes 20,000, and it's then consistent, you know, throughout the remainder of the year. And so as I've emphasized, this, you can play with this and change it so that it's relevant to your organization. But one thing I wanted to highlight is because we have a ramp time, and so think about the cohort 3, which did start, and we pay you full quarter amount, and so the revenue that you earn, sorry here, is more than the costs you incur. And it's because you don't incur full costs of your salaries. And what that ends up doing is you generate a surplus. And so as you submit your quarterly report, you'll submit this amount 3 months, and we'll have paid you a full quarter. And so it generates down here at the bottom a surplus in the first month. Now, if it takes you 2 months to hire somebody, and I said I wasn't going to do this, but I'm going to do it anyhow. You have 2 months of surplus, okay, and so on and so on and so forth. And so I'm gonna leave it for now. But the takeaway is you build an income statement for every one of your programs, and when we talk about what is a program, think of it as a contract, a different funder and a different contract. You want to have a separate income statement, which is what this is, for each contract that you have. And program, contract, they're the same thing, or profit center, but you don't want to bundle them together. You want to be tracking your costs and your revenue for each contract that you have. And so you'll, for as many contracts as you have, you'll have tabs here. And you'll build out your payroll here. And again, we're going to do this next week in more detail. And what it'll end up doing is giving you what's called a consolidated income statement. So it just adds everything together. And this is what your organization looks like and operates at a consolidated level, or in total. And once we've done this work of putting in all of the yellow stuff here in our assumptions, we now have the information to start looking at our cash flow and thinking about our cash flow. And so that's, once we're done with step one, which is completing the yellow tabs, we now can move on to the green tabs here. So I'm going to do that now. So we're going to do a bit of a shift here. And maybe before I do that shift, one thing to point out, since I'm on this tab, is, and it's in the guide, the first tab, the information of best practices. So you want to set your budget and project out your, this, right, what we just went through at the beginning of the year. This is typically done in June 2024. And you do this for all your programs, and this is what you expect the year to look like. What needs to happen is it's called reforecasting the business. So as you actually get your data, your bank statements, and you do your bank reconciliation, and you enter it into QuickBooks or whatever software system you use, you want to then plop in the actual information. And so it's no longer a forecast, it's reality, it's actuals. And every month, as you do your bank rec and you enter your information in your accounting system, you want to reforecast the business, which means enter in the actual financial information, and then take a look here at the rest of your business, which now we're calling a forecast. It's not a budget. Budget gets approved by the board at the beginning of the year, and then we see how we do against the budget, and we want to reforecast the business so that if things are very different, we don't want to continue with a bad assumption. So if my utilities end up being much less than this or much more, I want to then change my forecast number, right, in my example. So it's super important. Wanted to emphasize it in the context of this conversation, just because it's sitting up here for you to see. Is like, why is there actual here? Why is there forecast? And so we'll do this next week. As I've said, we'll actually pretend like we're building an organization and we're going through what I'm describing here. So for now, we've got our budget in for program 1, program 2. They add up here to the income statement. What I now need to do is build both a direct monthly cash flow and sorry, I'm going to do some stuff real time here so it's not confusing. We will want to take the information from the income statement and input the timing of the spend. Now, the monthly cash flow is generally pretty easy because we have a monthly spend here in my income statement, and we just input, you know, the different categories as I've defined them here in my monthly cash flow. So this is where, if you recall last week, you know, entering into a little bit of, you know, dangerous water, shark infested waters, talking too much accounting. I was an accountant. That's how I started my career. But cash flow is not the same thing as your income statement. And the best way to highlight that is up here. And if you recall, I talked about this last week. We earn revenue every day. As you provide the services, you earn that quarterly a piece, a daily amount of that quarterly award every day. And so for every month, 31 days in July, you earn 1/3 essentially of, in my example, if you recall, is 428,000 for 1 year. And we have these quarterly payments here that come in. This is where it's important for us to, we need to do the income statement and the budgeting. That's important for many reasons, like the 990 reporting and other external reporting will require that you show revenue earned, not just when did I get the cash. And so it's important to do both. But as we're operating the business, cash is much more important. Like there's this phrase, cash is king. And it is, right? It's we have to make payroll. We have to, you know, make sure that we're operating in a financially responsible way, which just means we're paying our bills, and we're most importantly paying ourselves and our employees, and we're making sure the benefits don't get turned off or deactivated and that sort of a thing. And so this is where we shift, right, from this income statement approach to a cash flow. Now they reconcile, they agree. So down here, I do a reconciliation because we need them to be the same. We don't want to miss any spend. And so it's very important that we pick everything up from the income statement tab and we reflect it here. And so I've input largely how we've been paying our you folks. We've consciously pay you up front very early. So this is maybe a good, again, cohort 3, year 3 example here of where the first payment, we tried to get that to you right away because we know the importance of, you need the money to be able to hire people and start the services in the program. And then they come in a little bit slower because there's a first quarter payment. And so if you notice here, it's 4 months until you get that second payment. So this is, again, a new contract. And then it's generally every 3 months. It's fairly consistent on when the cash comes in. So this is the cash coming in. And what we have here are the disbursements, right? This is the cash going out every month. And so there's a number of things I want to point out to you here. What happens with payroll is there's a 2 to 3 week delay from when somebody starts and when they get their first paycheck. And so you see here that my payroll, and this is where cash is different than accounting, I only paid $5,000, and you can look at the math here in the cell as to how I came up with that. And yet, if you recall, I incurred 10,000 of cost. And this speaks to this idea of when the employee first started, they earned a day's wages. And we need to reflect that here in terms of costs incurred. But we don't pay them every day, right? We don't pay ourselves. I don't get paid every day. We pay them, on this cycle that I've described, which is typically twice a month. And so that's why the cash going out is less, right, than the expense we show here. Both are correct, right? One is for, it's CPA, GAAP, generally accepted accounting principles, is what the income statement is. This is the real deal. This is cash, right? This is what comes in, this is what goes out. The other thing I would highlight is typically our insurance, and you probably all experience this, they want to, this is like corporate insurance, or think about workers' comp. This is not health insurance or health benefits, which is up here. They want to be paid upfront for the whole year. And so that's money out of our pocket, like the first month or day one. And so even though we get the benefit over 12 months, which is why we show the insurance over 12 months, right? I show, because again, this is when we're actually getting the benefit of the corporate insurance. It's not all up front, but we care about when we pay. And so that's important to note, specifically for insurance, is that's paid all up front. And then something else that's important to understand is we don't typically have to pay our phone bill and our utilities right away. We get to pay them next month, right? We get an invoice and we process the invoice, and it's typically about 30 days. And so that's why you see much less cash going out at the beginning than what is the cost or the expense incurred. And again, I think the best example is think of a faculty, an employee working and earning, one day's, cost or expense versus when we actually pay them. And so the other thing I would note to you, for you to see is all of this. So none of this is yellow. So all of this is coming from the income statement tab. So as we change the yellow sections, this all changes here. And one example of that was down here, if you recall, this is our surplus, and so I've highlighted this here. What the difference is between our actual spend and what we recorded as revenue, let's say, or we're funded. This is where I'm getting tricked up between CPA, GAAP accounting, income statement versus cash flow is where what you're hearing me get tripped up a little bit on. It's it can be a little tricky. So so this is the idea here is that we built the income statement, essentially the budgets by program, but then we need to go look at and you may want to change this a little bit depending on what's relevant to you. Maybe you have to pay all your vendors up front, and so they go here, and so this may need to get reworked. Maybe your insurance has quarterly payments, it's not all paid up front, that sort of thing. So you want to customize this a little bit, right? This should, again, directionally be correct and solid, for you as an organization. One thing I want to highlight, and we'll get into it next week, we can't go red. We can't go to the bank or the ATM and withdraw more money than we have in our bank account. And so this highlights a problem, a future problem, right? But a problem. And I purposely put it in here. I had us buying a car here because we thought we had the money to buy a car, but we actually didn't get separate funding to pay for the car. And so it puts us in my example here in trouble. If I just zero this out, we don't buy the car, everything gets fixed. And so we'll do a little bit more of this again next week. But this is sort of the first look as we think about cash flow that we want to take, which is the monthly cash flow. What does that look like here for the year? What do I expect and um, many of you probably know what cash represents as a point in time. And so when we say our cash balance here and we have a monthly date here, this is always the last day of the month. So just to be clear, cash balance is a point in time. How much cash do I have in my bank account at the end of the month? And this forecasts this. So you put this as part of your budgeting. This is part of how you get comfortable that you're going to be okay. Other than buying this car we can't afford, you're going to be comfortable with the cash flow. You're going to be able to pay your bills. You're going to be able to pay your employee based on what your budget is, right? And the thing that's important is reality isn't always what you forecasted or projected or wanted it to be. And so we need to do this to make sure that we don't identify a problem like one I've highlighted here, which is we can't go be buying things that we're not funded to buy, is essentially what this is saying. So you don't do that, right? You don't plan for it. And so that's where this is useful, this monthly cash flow. But what we want to do, and really what I wanted to focus on, the whole point of this series of training is to focus on our daily cash. And so this is now kind of really the meat of the whole point is how do we and I'm going to keep this small for now, so bear with me, please. And what I should do is highlight that there's two tabs here, and it has to do with the fact that the grantees and awardees are on two different cycles. So cohorts 1 and 2 are on the same, sorry about this, same cycle, and cohort 3, and it's actually called PA8, is on a different cycle. So their quarter ends December 31st. Cohort 3 and PA1, and so we've built a tab for that's relevant for those folks, and then we've built a tab here that's relevant for cohorts 1 and 2. When we give you your model to use, we'll delete the one that's not relevant to you. So if you're cohort 3, we're not going to give you the cohort 1 and 2 because it's just confusing. But for the purposes of the training, I'm going to walk through the cohort 1 and 2 since this is happening right now, right? We're in the month of December. And what happens here, and the purpose of the slide is to, oh, interesting. Let me go back and change something. See, I'm proving that this is all real time because I wanted to show something. If you recall, I changed this. I'm gonna put that back. And so what I've done here is we hired people earlier. I changed it to show you the change in the surplus if folks had started later, September 1st. But I purposely created my model to highlight something that went away. And so I've gotten back to people are starting earlier, and so we're paying people sooner. And so you see the numbers change. So these were not red when I looked at them, and I wanted them to be for this example so that we could, I could, talk this through to you and also emphasize why it's important to get your invoices in on time. And so, starting on the left here, some things that are important to understand is there are certain non-headcount, well, benefits is headcount related. There's certain costs that have to be paid the first of the month. Rent is kind of an obvious one, rent or a mortgage. Also true that our health benefits Kaiser and others want to be paid immediately, and they'll terminate you. They'll send you some nasty communications shortly after the first if you miss them. And so these can't wait. Others can. So when you think about your phone bill, or your utilities, you can pay them a little bit later. And so in my example, um, I have us having a regular, we pay in the middle of the month. So on January 15th, we're paying uh, uh, our some of our vendors, right? And think about our phone bill, right? And our utilities, our PG&E and whatnot. And so you want to put this into this template. When am I paying people? And it needs to come from your income statement. If you're looking up here, again, we don't put the assumptions in here. This is not a yellow section. We need to pull it from the income statement. And you need to build it for, like, this will be true. This will not change. You'll need to pay your rent and your health benefits, so keep this. Now, if you have a pay period, I've used the example of a pay period on December 7th and the 22nd. Many of you probably know you have to fund your payroll provider a few days typically before pay date. So I have on December 4th, and we need to know this. Like, when do I actually have to wire the money or send the money into my payroll provider? QuickBooks has a payroll module and a feature, and you can do your payroll through QuickBooks. And it may be the 5th, it may be the 6th, right? 2 days or whatnot. But you want to build this to align with your pay schedule. Sorry, I'm gonna need some water here. And so then what ends up happening here is we spend money, it goes out, and our cash balance goes down every day. And so there are many days in which we don't pay anything, right? And I've hidden a bunch of columns here. I have every day of December and every day of January, but I wanted you to you know see everything in one snapshot here. So I've hidden. For those of you who don't know how to do this, you can highlight an area and then you right click and you can unhide here if you want to see all the columns. I'm not going to do it right now. But here's the point. We started the month with $65,000, and this comes right from the information we put together in the yellow sections. And we started spending it down. And right now, I don't have any collections. I don't, nothing is coming in. And so our bank balance is going down, down, down. I have one payroll. I pay some more of my vendors, my utility bill. Oh, wait a minute, I've got a payroll coming up. In my example, it was January 2nd, 22nd, but I need to fund it. My payroll provider requires me to fund it a few days ahead of time. I don't have the money to fund my payroll. And that's a problem. And so there's two things that we can do. The ship has sailed, or the train has left the station on when we submitted our invoice. So it's super important that up front we get our information in, as I highlighted, before I hopped into this Excel model. Super, super important. You get your information in so we can send your invoice. If you get it in the second cycle, green cycle, you're fine. Like, you get paid Jan 8th to 12th. So sometime in this time frame, the 107,000 will come in. Everything's hunky dory. You wait to the blue section, things are starting to get dicey. Like, what if the check doesn't come in until the 20th, right? Because again, we don't know precisely when LA County / JCOT is going to pay us. We can tell you directionally, but you can't. This is risk that you can't assume as an organization. You cannot assume it's going to come in, and and so what do? Well, the thing we can do in this scenario is we delay paying our vendors. So I'm just going to make this 0. I just didn't pay my vendors, and we can do this. You can't do it a long time or our vendors get unhappy with us, but we can delay this and pay it after we get paid. And so that's one solution here. And in fact, that solution fixes everything, even if our third invoice um, is when we get paid, because I have nothing else going out in my pay cycle here. So we could push out paying some of our utilities, our phone bills, some of those vendors until we receive the money, essentially. Well, we can't pay them, right? Until we receive the money. And so that's an okay strategy, not ideal. The best strategy is, have us pay you sooner. Like, we want to pay you. Let's just, again, get those invoices in. We can turn around and pay you. One thing I wanted to do, since I'm on this tab, is this is a very important section here, which is why I've highlighted it in red, and it's this orange box here. If you notice, and I delete this, nothing happened. Sorry. Why didn't that happen? I don't know what happened to my example. Let me delete this one. There we go. I need to go figure out why that didn't happen there. But what I did is I took out one of our payrolls here. I just deleted it, and you see this now is not zero. And what it means is you've missed something. You haven't reflected all of your cash payments. And I'll go back and look at this 9001 and fix it so it's working. So super important that as you're building this out and like, hey, when am I paying people and whatnot, that you get this to zero. If you don't, then you've missed something. So it's going to be a problem, like, because you're going to have to pay somebody and you don't know it because it's not reflected here. So wanted to highlight that. I think the other thing I'll do now, just since I'm on this tab, is I'm going to unhide my columns here. And I wanted to show you, we've put in all the other pay dates for the rest of the year and into June, July of 2025. So you have them in your calendar, like, when do I get my invoices in and when can I expect to be paid? And then we built this for the cohort 3 and PA8, again, a different calendar schedule, but you have the dates here, and the model's the same, like the logic's the same as for cohort 3 and PA1. They work very similarly. And so I'm going to take a moment to catch my breath, and maybe Mina is a good time to field some questions. This really is what I wanted to accomplish today, was to explain the model to you, explain the tool to you, how it's working, how we use it, and ultimately where do we need to focus? Like, where's the value I get from this? And it's in these tabs, these daily, and even the monthly is useful, but it's really the daily where we're making sure we don't ever get ourselves into a cash crunch problem. Or if you are, working with your your advocate, to kind of help through what you see as a potential cash flow problem. So I think with that, Mina, I'm just going to leave this up, but are there any questions? I'm sure there are a few at least.
No, we actually already answered the majority of them, so
Ah,
there are none in the Q&A section. Thank you for mentioning that there will be calendars for every single year. That was a question. So when this series is done, finance is actually going to be sending out a toolkit. And within that toolkit, a calendar for every single year will be created. I know in the presentation, it's only, I believe, year 1 and 2. So year 3 and program area 8, you guys will be getting your own calendars. And we also do know that David references the 12.5 for quarterly milestone reporting for year 1 and 2. Year 3, yours is due on the 5th of January, which we know is a Sunday, but it's still due. So just definitely talk to your grant advocate if you expect it to be delayed a bit. But no other questions.
Maybe give it a moment
Of
just to
course.
make sure I've answered anything that may have come up. Maybe team, you don't have to say anything, Sandy, Dawn, Sam, or Lorenzo, but anything that you would emphasize that maybe I missed.
I don't think I'd say is,
Not, I'm sorry, go ahead, John. Go
sorry,
ahead.
Lorenzo. As you alluded to, hope's not a strategy, right? Like you want to plan for those worst case scenarios so you don't find yourself in dire straits, right? Especially when funding's limited.
Yeah, and I think the other thing, I want to emphasize is that, like Sam and Lorenzo and Dawn, like they're not tasked with building this for you, right? This is they're a partner to review something that you've done, but this is something that you need to do. They're here to answer questions and whatnot, but just to make sure set expectations correctly. Lorenzo, I think you maybe had something to say.
Yes, sir, if I may, just, and along those lines, as we're sitting in the presentation and people are asking, well, the 5th is a Sunday. So what does this do? The most important thing I think to take away from this is that there's a cadence to this. And the most important thing to realize is that the longer that it takes you folks to turn in your milestones and your financial reports, the longer your disbursements will be delayed. And so it's just common sense, right? So if I know that if my pay date is always on a certain day, but it falls on a Saturday or Sunday, then I know business practices is usually the day before, the business day before, or the business day after, whichever is closer. And so those are the kinds of things that we have to always be mindful of, as we are now organizations that expect to be taken seriously and professionally, right? And so it's just, I think that the takeaway is that there's a cadence to this, there's a schedule, and it all works out. And it's every quarter, your reports are due on the 5th of the month after your quarter ends. And then the biggest takeaway is also, we only have 4 opportunities to bill for you. That I think is the biggest takeaway of the whole schedule thing, without getting caught up on particular dates, and the understanding that there's only a limited time, and the more you wait, the further the disbursement will be. Thank you.
Someone did ask, in the income statement, are we supposed to include invoices that we are waiting on but have already provided services for? This would obviously be outside of this grant, but I'm wondering how it works in these terms.
Team, anybody want to take that? If not, could you repeat the question? Sandy, you got it?
I just need it repeated again.
Yes, so let me go back to it. Oh, shoot.
I think I see it. It says in the income statements, are we supposed to include invoices that are waiting on but have not already provided services for?
This would obviously be outside of this grant, but I'm wondering how it would work in these terms. Or waiting on to be paid for.
So
It-
let me try,
Yeah,
Sandy. And so what I think I'm hearing is so remember I had the program 1, which is JCOD, include everything you expect to get paid, in the future, right? So through your fiscal year, which is typically July 1 to June 30. And that's on the again, income statement and the JCOD program one, the cash flow, both the monthly and the daily cash flow should similarly project out, you know, for daily, it's 90 days. You should look out through your quarterly payment cycle. So your daily cash should be 90 days. And so you should project when you expect to get your invoice in and when you expect to be paid. And similarly, in your monthly cash flow, you want to show the whole year, the whole 12 months of your expected payment. I'm expecting to provide the services. I'm expecting to invoice and get paid. So I think that was the question. So that would be my answer. Sandy, I don't know if you heard something different.
I believe it was the same. I was thinking on the line that you did provide, you were being billed for services that you provided, let's say in the month of August, but you're not going to pay that bill till September. I mean, it does get complicated when you start thinking about the direct dollars going out, meaning cash, versus when you incurred that expense. So you incurred it in August, but you're not going to pay for it till September. I'm not sure if that was exactly what they were asking.
Yeah, I think, more to come. Please attend the Series 3 as we'll walk through, exactly those kinds of scenarios. And this idea of, it's complicated. I've been doing this a long time. Like, when did I incur the benefit or the cost? And which is different than when I paid for it. And so I keep going back to this idea of an employee, and they work every day and they earn one day's salary, and we need to show that as an expense and a cost incurred if we were to report one day, even though we didn't pay them. And so that's why we need to look at these in two ways. It's when did we earn the revenue and incur the costs, which is the income statement and the yellow program tabs, versus when did the cash change hands? When did it come into our bank account and when did it go out? And those are the green tabs. It's tricky, right? So if you don't feel bad if it's, trust me, I've been doing this way too long, and it's certainly tricky, which is why we'll walk through it again. Hopefully you'll use the tool. You'll find it beneficial. You'll find somebody who can use the tool. And then the team is available to help, right, as questions come up and you're actually trying to forecast your daily cash and your monthly cash. So please attend next week's training.
Just the PSA on next week's training. It's scheduled on the 17th, which is a Tuesday. So just want to remind
Yes.
everyone.
On the 17th, Tuesday at 2 o'clock. So there is a slight change. We'll send that information again in the email reminder. And then if you do have any finance related questions, need a budget modification, anything, please reach out to your grant advocate, reach out to your finance representative. Each year has their own representative. Year 1 has Lorenzo, year 2 has Dawn, and year 3 has Samuel. So if you have any questions, we always encourage you to reach out to your grant advocate. They are your resource to everything, and they should always be your first point of contact. And then this is being recorded, so we are sending this out in the next few days with the presentation. And again, at the end of the webinar series, we will be sending out the toolkit with calendars specifically designated for each year. But if you have any questions in regards to that, feel free to email me anytime. And there are
Thank you,
no
Mina.
questions, David.
Yeah, I should be projecting the calendar one more time. I, wanted to add a little bit more color to Lorenzo's comment on, yes, Sunday, January, it's the 5th in January is a Sunday. We want you guys to be super focused on getting the information in, which is why we want to be consistent that it's 5 days after a quarter ends, regardless of what day it falls on. But if, just to reiterate, we do have some time before we submit. It needs to be finalized and approved, right? So even though Jan 5th is a Sunday, we will submit all approved quarterly invoices. So this would be approved budget templates and milestones that are received by the 10th of January. Will be included on the 15th, right? So please push to get them in, but we're not. It's there is some wiggle room here a little bit, is what I'm trying to say, and I'm hesitant to like emphasize that because we definitely want you to take away the importance of getting the information in as quickly as possible. So enough said on that. So thank you, Mina. Thank you,
Of
team.
course.
Really appreciate all the help. Thank you all for spending the time, hearing me talk and have trouble coughing and drinking water. So I appreciate the time you've spent with us today, and look forward to joining you next Tuesday.
Yes. Thank you so much, everyone, for joining us. And if you have any questions, feel free to reach out to anyone. Have a great day, everyone. Bye.